Jake buys a rental property. They're both wrong, because one forgot to count the hours, and the other forgot to count the zeros. Let's keep this fair. They're the same age, same city, same financial starting point. The only difference is what they do with that 50 grand. Jake uses it as a 20% down payment on a $250,000 rental property. A modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment is about $1,330. He finds a tenant willing to pay $1,800 a month in rent. On paper, that's $470 a month in profit. Jake feels like a genius. Marcus takes the same $50,000 and drops it into a total stock market index fund. No leverage, no tenants, no keys, he says. Index funds. They nod politely and change the subject. Nobody's impressed. On day one, Jake has a house, a tenant, and a story to tell. It's not even close in terms of how it feels. For the first few years, Jake is living the landlord dream. Rent checks hit his account on the 1st of every month. He drives past his property and thinks, I own that, shaving a couple thousand off his tax bill each year. He is building equity with every mortgage payment. He's watching comparable homes in the neighborhood tick up in value. Marcus logs into his brokerage account once a quarter, sees the number go up a little, then down a little, then up a little more. Maybe $61,000. It doesn't feel like anything is happening, just a number on a screen. Jake's friends ask him about the property. The social proof alone makes Jake feel like he's winning by a mile. His mortgage payments total about $47,880. That leaves $16,920 in gross cash flow. Property taxes run about $3,000 a year. Insurance adds another $1,500. He's already replaced a water heater for $1,200, fixed a leaking roof for $2,800, and dealt with 1 month of vacancy that cost him $1,800 in lost rent, plus $600 to clean and relocate. But that means phone calls at 10 p.m., weekend showings, and coordinating repairs. Jake's actual net cash flow over 3 years is somewhere around $2,000 to $4,000, and that doesn't account for a single hour of his time. At roughly 10% average annual return, his portfolio is sitting at about $76,000. He spends 0 hours managing it, 0 phone calls, 0 emergencies, but Jake still has leverage working for him. $280,000. His equity has grown to roughly $55,000 to $65,000. That's real wealth, and it came partly from using the bank's money. That's the power of leverage, and it's the one advantage stock investors can't easily replicate. The rent check is the number everyone talks about. It's the number on the YouTube thumbnail, the number at the real estate meet, the number your landlord buddy brags about at the barbecue. What nobody talks about is everything that comes out of that rent check. Vacancy. The average rental property sits empty about 1 month per year. When a tenant leaves, you're paying for cleaning, minor repairs, listing fees, and your own time to screen and show. Maintenance and repairs. The general rule is to budget 1 to 2% of the property's value per year for maintenance on a $250,000 house. Other years, it's a $7,000 HVAC replacement that you didn't see coming and can't postpone. Capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10. Todo se. These are guaranteed future costs, and they come in chunks of $5,000 to $15,000. If you're not setting aside money every month for these, you're not running a business. You're running on luck. Property management. If Jake hires a manager, that's 8 to 10% of monthly rent gone immediately. Roughly $150 to $180 a month. If he manages it himself, he's working a part-time job. He's not getting paid for. Either way, it costs something. And then there's the one risk nobody likes to discuss. Bad tenants. A tenant who stops paying and knows the eviction process can cost you 3 to 6 months of lost rent plus legal fees. That single event can erase an entire year's profit or more. None of this shows up in the $470 a month cash flow number. But it shows up eventually. By year 5, Jake is deep in the reality of being a landlord. He's on his 3rd tenant. He's replaced the roof for $8,500. dealt with a plumbing emergency that cost $1,400, and spent 1 month with the property empty. He's raised rent to $1,950, which helps, but his property taxes and insurance have gone up too. His actual cash return, the money he pockets relative to the money he put in, is hovering around 3% to 5%. Not bad, but not the 15 to 20% return he told his friends about at the barbecue. Marcus is still doing absolutely nothing. His portfolio has grown from $50,000 to roughly $135,000 to $150,000 by year 7, including his $300 monthly contributions. He didn't pick stocks. He didn't time the market. He didn't do anything except not touch it. The compound growth is starting to accelerate. The gains on his gains are now generating more new wealth each year than his original contributions. Here's what's happening. Underneath the surface, Jake's wealth is growing, but it's growing slowly after expenses, and it requires constant attention. Marcus's wealth is growing in a curve, slowly at first, then faster and faster. Compounding is boring for the first 5 years, and astonishing for the next 15. By year 10, Jake's property is worth roughly $335,000 to $350,000. His remaining mortgage balance is about $166,000. That puts his equity at approximately $170,000 to $184,000. Over 10 years, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, Jake's total out-of-pocket, beyond the original down payment, is somewhere between $20,000 and $35,000. Marcus's portfolio, with consistent $300 monthly contributions and roughly 10% average annual returns, is sitting at approximately $165,000 to $180,000. He put in $50,000 up front, plus $36,000 in contributions. $86,000 total. The rest is pure compound growth, and he spent exactly 0 weekends fixing anything. At year 10, they're surprisingly close in total wealth. Jake might be slightly ahead thanks to leverage, but here's the thing. Jake also spent hundreds of hours managing his property, took on hundreds of thousands in debt, and concentrated his entire investment in a single asset in a single zip code. Mark is diversified across thousands of companies and never lost a night of sleep. This is where the story fully separates. By year 20, Jake's property is worth roughly $450,000 to $500,000. His mortgage is either paid off or nearly there. His equity is somewhere between $400,000 and $500,000 depending on appreciation. He's been collecting rent the entire time. But after 20 years of maintenance, repairs, turnover, taxes, insurance, and at least 1 major renovation, his total net profit from cash flow might be $40,000 to $80,000 above what he spent, maybe more in a hot market, maybe less in a flat one. Marcus's portfolio, at 10% average annual return with $300 monthly contributions. His original $50,000 has grown to approximately $420,000 to $460,000. That's with total contributions of $122,000 over 20 years. The other $300,000 plus is pure compounding. No debt, no tenants. Number 2 a.m. phone calls about a broken pipe. When you compare net worth, they're in the same ballpark. Somewhere between $400,000 and $500,000 each. But how they got there is completely different. Jake worked for his. Marcus waited for his. Jake had stress, risk concentration, and illiquidity. Marcus had volatility, but liquidity and freedom. And here's the part that changes the math dramatically. If Marcus increased his monthly contribution by even $200, by bringing it to $500 a month, his 20-year portfolio jumps to roughly $550,000 to $600,000. That's because in the stock market, increasing your contribution has a multiplied effect through compounding. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. If I only showed you the downsides of real estate, I'd be doing what every stock market influencer does. Stocks have real risks that people love to gloss over. Volatility is brutal. In 2008, the market dropped roughly 37%. In March 2020, it dropped 34% in a single month. If Marcus had $150,000 in his portfolio and watched it fall to $95,000, that's not a number on a screen. That's gut-wrenching. And the data is clear. Most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible time. There's no cash flow. Unlike a rental property, index funds don't send you a monthly check you can spend. Dividends exist, but on a total market fund, you're looking at maybe 1.5 to 2% yield on $150,000. That's about $200 a month. That's not replacing anyone's income. No leverage. Marcus used $50,000 to control $50,000 in assets. Jake used $50,000 to control $250,000 in assets. That 5-to-1 leverage is powerful when property values rise. And it's the main reason real estate creates more millionaires than the stock market. And there's no tax magic like depreciation. Real estate investors can deduct the theoretical decline in their building's value, even if the property is actually appreciating. That's a legal tax shelter that stock investors simply don't have access to. Real estate wins in specific identifiable situations. If you're in a market where the rent-to-price ratio is strong, meaning monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. If you're willing to treat it as a business, not a side hustle, screening tenants carefully, budgeting for capital expenditures, building systems, the returns can exceed stocks, especially with leverage. If you use strategies like house hacking, living in one unit and renting the others, you can reduce your own housing costs to near zero while building equity. That's something the stock market simply can't do. And if you understand 1031 exchanges, which let you defer capital gains taxes, by rolling profits into a new property, you can grow your real estate portfolio tax-free in ways stock investors can't replicate. Real estate isn't a bad investment, it's a misunderstood one. Jake and Marcus both walked away from that decision, thinking they were making the smart play. Jake thought real estate was the proven path to wealth. Marcus thought the stock market would do the work for him. Neither of them actually sat down and mapped out what this costs. In dollars, in time, in stress, and in risk, over 10 or 20 years. The real trap isn't real estate, and it isn't stocks. The real trap is picking either one based on a YouTube headline, a podcast clip, or something your uncle said at Thanksgiving without ever running the full numbers for your own situation. And if you're wondering what happens when you do both, when you own property and invest in the market at the same time, that's a completely different conversation. And the math might change everything you think you know. But for now, the next time someone tells you, real estate always wins or the stock market always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters.